Time now to check in on how U.S. markets wrapped the day and what impact inflation data may have had. CGTN's John Tarrant has the details from the New York Stock Exchange.
There were yet more records, well, at least one record on Wall Street on the Tuesday session, and this despite higher than anticipated CPI, the consumer price index, inflation paid by Americans in the stores and the gas stations. It was much more than had been anticipated by the Wall Street experts, but within the report there were signs that things are slowing down, and Wall Street believes that they certainly are. Inflation is coming down, just not as quickly as everybody hoped for, and Wall Street is coming to the realization that maybe the first interest rate cut of the year, which has been promised by the central bank, the Federal Reserve, may not actually be in June, as they thought just a handful of hours ago. Anyway, the market's overlooking CPI completely, and the Dow was ahead by 0.6%, 235 points, to stand at 39,005. The Nasdaq was up 1.5%, with Oracle, the software company, doing really well, up 12% and boosting the Nasdaq. The S&P 500 ahead by 1.1%, 57 points. That is a closing record, 51.75. Bitcoin down 1.3% on the Tuesday session. On Wednesday, earnings come from the luxury goods maker Vera Bradley, and the vote in the House of Representatives in Washington on whether or not to ban TikTok will begin at 13:30 GMT on Wednesday. John Tarrant, CGTN, on the trading floor of the New York Stock Exchange.
And for more insight on U.S. inflation and the economy, I spoke to Mark Hamrick, Senior Economic Analyst at Bankrate. He began by discussing how oil prices and energy were the biggest factor when it comes to the new CPI numbers.
If there's good news here, it is that food was flat, but shelter, which we all need to live somewhere, continues to rise. And so we're in the low 3% range on the headline year-over-year change on the CPI, the Consumer Price Index, the main index measuring inflation at the retail level, but still in the high threes on the core rate, which excludes food and energy. But the Fed does not, let's say, make it a priority to measure the CPI relative to where it wants to be. It watches something else called personal consumption expenditures, and that number is in a lower range and getting closer to the Fed's 2% target. So they will look at these latest numbers and say, we know this is a bumpy ride for inflation, and this is yet another bump, but I think they have some confidence that there is sufficient restriction being put in place with high interest rates that they will get to their destination.
Well, let's talk about that a little bit more closely, because what does need to happen specifically to get to the Fed's 2% inflation target? And do we get there? Because this last mile from 3 to 2% has proven to be quite difficult.
Well, again, we're talking about the PCE being the Fed's target. That is what they're watching. That's what they forecast. And what we primarily need here, Karina, are two things: time and patience. The Fed's medicine is in the system, and it's working its way through the system. But for consumers, businesses, investors, it's taking too long. But that's the way it's going to have to work, because we saw the worst inflation in a generation, as we all know, when the CPI year-over-year change was 9.1%, not in the low 3% range. So we've come a long way, and we still have some way to go. It's going to take time. It's going to take patience.
We have come a long way indeed. What will the Fed take away from this specific report? Jay Powell said the Fed is looking for more confidence inflation is heading in the right direction. But consider this CPI data in tandem with that, jobs report that we got last week that many people that I spoke to, analysts, said was an almost perfect report that came out. Still creating jobs, but unemployment ticking higher and wage growth slowing. Just what the Fed has been looking for, right? So how does the central bank reconcile the two?
They believe the job market is in a pretty good place. They believe the supply and demand of labor has come into better balance, as opposed to a couple of years ago when it felt as if, and indeed perhaps was the case, that workers held all of the power within their ability to negotiate or find new work. But right now, the Fed is focused on the one part of its dual mandate that hasn't been working so well, and that's stable prices. And so many prices are stabilizing, but there were some outliers here, and there probably will continue to be. So in the latest reads, for example, if you go into the grocery store in the United States, you'll see beef prices are up, pork and chicken are down, sugar is up. whereas some of the other key prices are more stable. So ultimately, we want to see more decline in prices of services because we are seeing goods prices coming down, and we need to see energy behave just a little bit better. But as you know, that's very difficult to predict, and it's very difficult to get through a prolonged period of time without some volatility, particularly with gasoline prices.
Absolutely. And President Joe Biden wants to see those grocery prices come down. It's an election year as well. I want to ask you, what's the potential, Mark, of pushing rate cuts out even further? The consensus is probably June we may see a cut, perhaps July. What's the risk of waiting too long? It's certainly something President Biden wants to see, doesn't want to see happen in an election year. He wants to see those cuts come rather quickly.
Well, he can pray and wish all he wants. The central bankers are going to do what they think is necessary to achieve their dual mandate. Obviously, there's some urgency for policymakers at the elected level as well. But in terms of what the Fed is going to do, they have a meeting that's about a week away, and they've already said they're not going to move interest rates at the March 20th meeting. So to your point, Karina, we should look perhaps to the early part of the summer for the possibility of the first rate cut. What do we have to do between now and then? Get a lot more data that makes the Fed feel additionally confident that it can reduce interest rates because it is getting closer to that promised land of the 2% inflation target in the PCE.